Hello, how are you? You are muted at the moment.
I can't hear him.
You can hear me now. You have your computer muted, maybe?
Muted.
Are you muted?
I can't hear you.
You might be muted. I think your speaker is muted. I think.
I miss hair. I know you have a whole bunch of it, and I'm like, I have no hair.
Can you hear me now?
I think your speaker's muted. Ours is not.
Can you hear me, Connie? Connie?
What?
Can you hear me, Connie? Maggie, can you say hello and see if they can hear you?
There we go.
There,
Hello, can you hear me now?
we can hear you and they can hear us.
Mhm.
Not sure which way this awesome straw hat goes, but I'm gonna maybe rock it for mortgage day. Hey, yo, see what I did there? We're not gonna rock it no mortgage on mortgage day. I was going to rock it.
Good morning.
Good morning, Maria Jackson.
Good morning, Maria.
Morning.
We just got through doing a pricing pros. Well, I'm gonna go ahead and start the recording, and I'm Teddy Pins. I've got my fancy mortgage hat on today, go figure. We have the amazing Connie, Eddy, and Roger Gore. These are veterans of the business, and we are so lucky that they are here with us today to share so much knowledge about the ins and outs of mortgages and becoming a mortgage master. At least one enough that you can better understand for yourself and for your clients to help make this process as stress-less as possible. And so today I'm going to go ahead and share screen. They've prepared a presentation for us. And as I mentioned, if you have questions, put those in the chat and I'll be minding those. And I am going to turn it over to them and go ahead and share my screen here. So here we go. Give me a thumbs up if you can see. Oops, sorry. Come on, I'm not trying to edit your slides.
I get terrified of sharing my screen.
There we go. Can everyone see that screen in full effect?
We can see it.
Yeah.
Great. Do you see just the slide? Is it the full screen?
Just the slide.
Perfect. Great. Okay. Well, I will turn it over to you. Just tell me next slide when you're ready and take it away.
Hello, everyone. Thank you for having us. We appreciate getting this time in front of you. If you have any questions along the way, just raise your hand or holler or speak up. Want to go ahead and take it away, Connie? Want to move to the next slide?
Yeah, next slide. Okay, so this is just like our agenda, what we're going to go over today about interest rates, where do they come from, how often do they change, what influences the rates, private mortgage insurance, the PMI, how to decide on a lender, and top tips for getting to the closing table on time. So that's what we're going to cover today. We'll go to the next slide.
Trying, sorry about that. There we go.
You want to start?
Interest rates, what are they and where do they come from? So in the mortgage world, there's a lot of things that can contribute to interest rates. There's nothing that is a direct correlation, but there are several factors going on in the economy, things of that nature. But the thing we track the most in our experience is probably the 10-year treasury. There's a long proven history, and we'll show that to you shortly, that the 10-year treasury trends to very well track with the 30-year fixed mortgage rate. So that's probably our number one thing that we look at. There's along with mortgage-backed securities. Interest rates come out every morning at about 9:30. There are some lenders that might put theirs out at 9 a.m. and they're hedging a little early. Some might put theirs out a little lower. They're hedging a little more safely. They don't, when the federal government is closed, there is no interest rates that day. And that is when a lender, a good lender, not all lenders do this, most have an overnight or a weekend or holiday price protection. What that means is on Friday afternoon, I give you a rate quote. I can usually honor that rate on Saturday and Sunday and lock you through. And then, come early Monday morning, we're subject to brand new rates.
And that's important because a lot of times you guys are writing contracts and having those accepted over the weekend or in the evenings, and we can go ahead and lock those rates in so that we are protecting that rate for the customer over the weekend. They're not subject to whatever the rates are on Monday.
It also can really come in important, and like with first-time home buyers who have very little cash to the table and we're scrimping for every dime and dollar. And if all of a sudden the rate goes up and now it costs us, say, a quarter or a half a point, which we discussed earlier what a point was, to get to that same rate, you've already negotiated a contract. We may not be able to add higher seller paid closing costs at that point in time. So it can be really important when you're looking for very accurate numbers. Connie, you want to go into Fed Mon policy?
So you can just read through this. Monetary policy generally increases in the money supply put downward pressure on rates, tightening money when the supply is pushes it upwards. And so that is definitely tied to it as well. Unemployment, GDP, consumer confidence for sure. I mean, all of these things really can impact the rates. But again, we really see a lot of it is based on that 10-year treasury. I think is probably the best factor to use. You can go to the next screen.
I was going to add, when you see things like GDP, consumer confidence, what that basically means, those are indexes published by think groups, study groups, the government, certain agencies. There's a published schedule at how often they come out. And we get warnings that this announcement's coming this week. Now, usually a lender and the market has already prepared. They already know the expectation as to what is happening or expected to happen. And that's typically already been priced in. Where the surprise comes is when it doesn't meet the expectation. It either comes in higher than expected or lower than expected. And that is when then you'll see a price change to the good or to the bad.
And this is really a site that we follow. It just shows you, this is actually the last year for the 10-year treasury. And you can see in that period of time when it was the lowest, like around that, July 2020 through about, December or so, that's when those rates were really in those low twos. And then you can see how that movement has gone up now, and we're back into, the low threes. But this is, as that 10-year treasury was changing, that's when we were really seeing that movement in the rates.
The green obviously being positive movements and the red being negative.
Yeah.
And I think we have the next slide kind of shows you how that correlates to where our 30-year interest rates on average were nationally.
Yeah, so that top line is the treasury, the 10-year treasury, and then that bottom line is what the actual mortgage rates were. And you can see that they're almost identical. So that movement was really tracked by, just really almost identical on target to that 10-year treasury. So again, if you're kind of looking for something to monitor, that's really just a good, baseline for you to
Is there a rule of thumb between the correlation of, and I apologize, I had to change the view from slideshow because it takes away my view of who's on camera or other things, but is there any correlation to that 10-year treasury? Would you say it's typically 2 points higher than the treasury, or is there any rule of thumb to that?
I don't think there's any really exact rule of thumb to that, because honestly, at one point, the treasury was so low, and when the rates were in those twos, we actually during that period of time saw that climbing, but there wasn't really any movement in the rates. It was like within a certain margin, it still remained in those mid to low twos. Then once it started going over 107 or so, It would then, it hit a certain ceiling, and then we started seeing those rates tick up. So it's not like there's an exact, it's always going to be 2 points over the treasury.
Sure.
And that was all kind of unprecedented. There was a lot of talk in our industry. Most of it was just chalked up to COVID and the election debacle, because it didn't follow any of the normal economic trends. So it was kind of just a shot in the dark. Every time they tried testing a different change in mortgage rates, there was a pushback. So that's why the mortgage rates remained really low.
Excellent.
Now we're getting back into kind of the more norm
Mhm.
as COVID is moving on through, the election is settled in, that kind of thing.
Gotcha. Okay.
All right, so this is what determines the borrower's specific rate. There's a lot of things that factor into that. The loan types, we've got conventional, FHA, VA, THDA, USDA, and portfolio loans. So just depending on the type of program that the borrower has is going to determine the interest rate.
The very
Okay.
first question Connie and I typically get on a phone call is, hey, what is your interest rate today? That is what we get every time. What is your interest rate? And we then have to kind of hit this scenario and say, well, every interest rate is very different. It depends on your situation and what are you looking to do. And we have to get into a conversation like this because those interest rates there could vary 2% between different scenarios.
Mhm.
Sorry.
Yeah, so yeah, exactly. And that's exactly right. We're having those conversations. How much are you putting down? What terms are you looking for? Because all of these things factor into what the rate is going to be. So it's not like, it's just one rate fits all. So, the loan term
I think that's like somebody saying, what's the price of a house in Nashville?
rate.
Exactly.
Exactly. Yeah.
Or the guy that says, I need a light bulb here at Home Depot. I just need a standard light bulb. And the guy says, I just picked the first one that's closest to my hand, because there is no standard, right? There's so many variables to that. And I think that's what we want to help be better advisors to our buyers about is the comparison. And they're all looking at these things as a commodity. And there's so many factors that influence it. And I'm so grateful. So go ahead. Sorry about that.
Yeah.
No.
So no, love the input. It's the terms obviously of the product too. If you're looking at a 30-year term versus a 15-year, 15 years is going to be a lower interest rate, obviously a higher payment because the term is lower. One thing I think is worth noting, a lot of times people are thinking, what's your adjustable rate mortgage? That's probably lower. Well, actually right now it's higher. It's actually a higher interest rate than a 30-year fixed.
And has been for
For a while.
almost 2 years.
Mhm. Yeah, so those really aren't more attractive at this time. They were, years ago, but now it's actually, it's much better doing a 30-year fixed. And of course, the purpose of the loan, if they're purchasing or doing a refinance or cash out, that's going to affect the rate dramatically. A purchase is always going to be a lower interest rate than a refinance, and then especially too, if they're doing a cash out refi, then that rate gets even higher.
A cash out refi means they are either taking, so on any rate term refi, they can get back up to like $2,000 or 1% of their loan amount. And that's still considered a rate term. And that allows us to have a little wiggle room so you're not going back and forth to the closing table and underwriting regularly. But cash out means they're paying off credit cards. They're actually taking hard, real cash to do something with in the future. But another one that a lot of people miss that I'll give you a little extra insight is if somebody has a home equity line of credit, which is very common, or a second mortgage, usually it's a home equity line of credit secured against their home, and it was not taken out at purchase. It is something they got later in time or redid it later in time or increased the balance later in time. That makes it a cash out refinance and completely changes their terms and the LTV that they can borrow against and things of that nature.
That would be different though than a traditional HELOC, right? I mean, you're essentially
Traditional, if it wasn't got, so if you get, you split them, when you buy the house, we used to do what you call the old fashioned 80/20s.
Yep.
Sometimes we'll still do one. And if it's really close on their down payment, sometimes Connie and I will structure a loan with an 80% first and maybe throw a 5% second behind it because they only had a 15% down payment. And they didn't want PMI and we were just trying to head a different option for them. If we did that at closing, when they bought the home and they came back later to do a refinance and they had never changed the terms to that equity line, then that would still be considered a no cash out refi. But if you buy your house and then later out, a year, 2 years, 5 years later, you decide you want to go get a HELOC for something reason, later on you go to refinance, that is now considered a cash out mortgage.
Awesome.
Comes up more times than you would think.
So another thing that, obviously changes the rate is occupancy. And we just talked about this a little bit. Primary residence is going to be your lowest interest rate. And then, of course, the second home, now those rates are considerably higher and investment is, quite a bit higher.
Still awesome.
But, again, that's where that's really been impacted is those second homes and investment properties. Type of property, if you're looking at a single family residence, that's going to be a lower interest rate than a condo. If you're putting less than 25% down on a condo, once they hit that 25%, then it's the rates are comparable to a single family residence. They're looking at a multifamily, a 2 to 4 unit, those rates are, again, going to be considerably higher.
Something I'd like to kick in there too, because a lot of realtors in my experience don't know this. A 2 to 4 unit. So if you've got somebody who's kind of shopping duplexes, unless they can go FHA as a primary residence, it's a significantly higher down payment.
Yep.
Interesting.
Yeah.
You're
So
looking,
even if they're going to live in the property as a duplex, if they're doing a conventional loan, then they
25% down.
Have to put 25% down.
I'm hearing this 25 number a lot more than the 20. It seems to be the new norm or more norm at getting the banks want a little more equity from the borrower. True?
Yeah, true, but in all honesty, the duplex on conventional has long been 25%. That's why we
Gotcha.
typically try to move a FHA when we can in that situation.
And on an FHA loan, if they're purchasing it as a primary residence, they can still do the 3.5% down. It's just when they go conventional. On a conventional loan, they look at that other piece of it being more of an investment. So they are hit with that. They still have better rates as a primary residence, but they are required to put a much larger down payment on a conventional. Okay, and then lastly, just the structure. If you're doing like down payment assistance, that's going to be a different rate. The loan amounts can factor into what the interest rate is and purchase price. So, the loan to value, of course. So,
Awesome.
yep.
Any questions here?
Okay.
Private mortgage insurance. A lot of, typically we refer to that as PMI. If you're getting a government loan, an FHA loan, then that's just referred to as mortgage insurance, MIP, mortgage insurance premium, but they're basically the same thing. Connie, you want to chat about it?
Sure. So, so PMI, basically, anytime that they put less than 20% down on a conventional loan, the mortgage insurance is going to be required. There are different options. And as far as like how much they're putting down really factors into what that mortgage insurance is going to be. So it's determined by their credit score and down payment. So the higher the loan to value. So the less they're putting down, the higher the mortgage insurance premium is going to be. And, so if somebody's putting 5% down, it's going to be a much higher rate than it would be if they're putting 15% down. Now on a government loan, the FHA, it's the same, pretty much the same rate, whether they put down, whatever they put down. And quite honestly, even if they were putting 50% down on the loan, they have to do an FHA loan. They still have mortgage insurance regardless. So 20% down, whatever, does not get them out of that mortgage insurance on an FHA loan. And it's actually for the life of the loan. So it's much different on an FHA loan than it is conventional. Conventional, it will drop off once they reach 78% of the original loan amount. But they can actually request it to be removed once you have 20% equity in the home. So as prices are increasing so dramatically here, they do have the opportunity to have that request to have the mortgage insurance removed once they can prove that they've got the 20% equity. And again, I mean, gosh, here that could happen in a couple of years. So
This mortgage insurance premium used to be a much more standard product. Over the last 5-6 years, as I guess software and online accesses and apps on phones, they've become more creative. At one point in time, there was a chart and you just kind of went across what's your credit score, what's your LTV, and there was a factor. Now it really can. So on the next slide, you'll see where we actually shop, and it's kind of built into our software, and we will go and compare multiple companies and see what's the best. And they've gotten a little more aggressive with each other. Sometimes a second homeowner, a co-borrower, can make the rate a little lower. And then a lot of times our income-based programs or first-time home buyer programs can also give them a further discount. So those are the kind of things that we plug in and then try to make sure that we get them the best rate.
yeah, so yeah, and some of those first-time homebuyer programs, they are income restrictive, but if they meet that requirement for the income, you can really save somebody quite a bit on the mortgage insurance.
The biggest thing I like to say about mortgage insurance, because realtors in general and lenders and borrowers are terrified of it. And in all honesty, it used to be really high. I mean, it would be a few $100s on top of a payment sometimes. I will tell you that if somebody can get to about 10% down, anymore, the mortgage insurance rates are not that bad. They're very minimal.
And if somebody's putting down as little as 5%, we do have some options of doing like a single premium where they can sort of buy that out up front and finance it into the loan. So, you know, that's been a kind of a creative option to basically just sidestep and get out of that mortgage insurance up front. Again, just by paying that single premium and actually financing it into the loan.
And single premium, basically, it's just putting one lump sum dollar cost to the whole PMI.
And that's what we're seeing here at the bottom, right? This upfront premium.
Yes, yeah. So that's an example of that. And on that, I would think we're looking at a 1.8 cost.
Yeah.
Again, that's pretty, it just correlates to the loan amount and that percentage. You're paying that upfront, financing it into the loan. In some cases, we may have to do that to just help somebody qualify for the mortgage, because it takes that mortgage insurance payment out of it and will help them actually qualify for more.
On their debt ratio. One thing that Connie and I sometimes as well do, a good loan officer, sometimes, you know, there's higher seller pays than needed. So you've negotiated into a contract up front before we really ran numbers, and there's extra money sitting on the table. Sometimes Connie and I will look at this scenario. Is there a way maybe we can just use that to pay their PMI premium and completely get them out of it instead of leaving those unused dollars on the table?
And it just speaks to the answer of, like, when you go to buy a car and they say, what do you want your monthly payment to be? And I always hate that answer, because it's like, I get you can make the numbers work. I just want to talk about the price of the car. But it's dangerous when people are comparing simple things based on monthly payments or just rates, because it doesn't tell the whole story. So I'm so thankful y'all are sharing this.
The big one.
How to decide on a lender. So, just choose us.
Choose
Make
us.
it simple.
But number one really is your realtor recommendations. You know, what your voice to your borrower goes a long way.
Yeah.
I know that it goes so long that I've had people that have been pre-approved with me, and then their realtor gets in their ear when they end up with a realtor that I do not have a relationship with, and pretty much bullies them to use their guy or coerces. So a relationship is very, very important. And we really do want your business. We're trusted partners here with Village. Connie and I have a wealth of experience, and we have a team committed to getting your closing smooth, on time, and not missing a closing date.
And you're going to, you know, develop those relationships with the lender and know, you know, just they're going to prove, you know, they'll be proving themselves as to, you know, being able to get your closings to the table on time and have a smooth transaction for your borrower and have a you know, pleasant experience. I think it really comes down to that service, and which is the next bullet point, you know, the service being the availability, the creativeness and determination, experiences versus the order takers. And, just some of the online lenders, those big box lenders, they may not have that personal touch that I think that we can offer, or someone local can offer to your borrowers. It's just, you get into like, and I worked for a Bank of America and a Wells Fargo. And, it was not as great of an experience just because our underwriting was in Florida. And, you lost a little bit of control over that process. Just, I remember when things would get really aggressive and the market was, crazy, their biggest thing was to say, to reset expectations to the buyers and to the agents because they couldn't close loans on time. They were just so packed with business. And honestly, sometimes you'll see that those bigger lenders just don't care, or the online lenders, you kind of lose that, again, that personal touch. We try to really be able to meet with your buyers if we need to in person, be available to everybody on the weekends or in the evenings. When you guys are out there writing contracts and needing a pre-approval letter, or somebody needs an estimate, we really try to respond and get that to you no matter what time of day it is.
I have taken my laptop on the lake so many times, because I know how urgent it is for you.
Mm-hmm.
When you're dealing with a lot of online lenders, things like that, and you're comparing to them, or even maybe, her uncle is a banker in Chattanooga at a local bank, they tend to shut up shop on Friday about 4:00, and you're really waiting until Monday. If you're dealing with an online lender, typically you're calling in and you're just going to the next person who's got the shift, who pulls up your file, who doesn't even know your file because it's probably not the original loan officer. And all those things can really be important. The other thing about a lot of online lenders, they don't give you the amount of service level. And when we're talking about creative and determination, most of them are newer in their career. It's kind of a training ground for a lot of mortgage loan officers. They go get their license, and then they join one of the big online lenders. They get a lot of hands-on training sitting in a call center environment. So they may be able to do the vanilla stuff really quickly and easily, and they may be really, really friendly. But when you present something outside the box, that's when they start running into a lot of challenges.
Yeah.
Third, comparing.
Yeah, so when you're looking line by line on the estimate, quite honestly, most of the fees that you're going to see are really going to be the same with whichever lender they use. So, but there are some fees, just the actual lender fees themselves, underwriting, processing. Some companies will break it up into, several different groups, like a processing fee and an underwriting fee.
Credit report fee.
Yeah, so those fees are lender specific. And I think that's really the best thing for somebody to compare one lender to the other. So when it comes down to the escrows or the deed stamps, those are going to be the same no matter who they use. Because that's really just the way that they're set up. It's always a percentage, across the board in the industry. That's really going to be the same. So you're really going to compare maybe even the appraisal fees, but those are going to be pretty close. We still have to. We're only going to charge what we're actually invoiced from the appraiser, but we may have an estimate that gives you just a line item of what we expect that to be. But it's, again, we're only going to charge, just like every investor every lender can only charge what they're actually invoiced. So I think most of the comparison fees are going to be, the actual lender fees themselves, credit report and
underwriting, dot prep, processing, origination. Those top line items are controlled by the lender. Everything else will end up the same. If you use Rudy Title is charging the same closing fee and the same title insurance, regardless of the lender. Your homeowner's insurance agent that they secure is charging the same annual policy regardless. The state of Tennessee and the county of Davidson County are charging the same fees. So really that comes down to who is more experienced and better at providing estimates to their borrower. And Ted keeps asking, like, what are little known secrets? One of the best ways of comparing I suggest is if they've gotten some estimates, get that loan officer on the phone and have that loan officer go through that estimate and explain it. Because I will guarantee you about 70% of loan officers cannot explain to you how those fees are calculated. Deed stamp, their computer spits it out. They don't know that it's 0.0037 times the purchase price or 0.00115 times the loan amount. They don't know that the recording fees are $5 per page plus a $2 handling fee, and that an extra page could be a PUD rider when you're in a planned urban development or a condo or an ARM. You're adding an extra fee to that. And that's the best way to shop for a lender. If your loan officer cannot explain that to you with a thorough understanding, to me, that gives you all you need to know about that loan officer on that pre-approval that you received.
Yeah, and there are some fees too. Just if you've got a buyer that's looking at a condo, make sure when they are getting estimates from a lender that they are calculating in like HOA dues, transfer fees, condo questionnaire fees.
Working
There's
capital.
there's quite a bit in a condo that can be added to the fees. And just because somebody doesn't put it on their estimate doesn't mean it's not going to be there at closing. So, they may get caught later by having those fees, because those are actually fees that are considered that they can change between the time of the estimate and the closing. So I know whenever I've got somebody that's purchasing a condo, and of course we do a lot of condos, that we're, adding a lot of those fees in. And I'm going to, because they may not even have, particular property yet. We're just estimating what they are, but I always put them in the estimate. The HOA dues collected, working capital, transfer fees, condo questionnaire, and maybe a little bit on the high side, but because they can always go down. But I'd rather prepare someone that's going to be part of their costs.
And you're talking, when we say those fees, I mean, that's easily a $500 to $1,000 sway on their closing cost.
Mm-hmm. Yeah. Can make a big difference. So, okay. And I think on the next screen, we're talking about the APR. If we want to go to that. So just understanding what the APR is and what does that mean to the buyer. So basically the APR is it's the closing costs in a rate calculation. So it's to use really for them to be able to use to compare products and see which is the best type of loan for them. So again, most people say, they're asking about rates and APRs. Right. And I'm sure you guys have heard that from your buyers as well. So they're looking at like, what's my rate? What's my APR? But again, the APR is really used as a tool to compare products. The example I have here is looking at a conventional type loan versus an FHA. The top one is the FHA loan, and that rate is at 2.875. The APR, though, is at 4.34 versus the loan scenario on the bottom. We've got an interest rate at 3% on a conventional, and the APR is 3.152. So even though the rate is higher, the APR is closer to the rate because the fees are less on that conventional loan. So again, it's like the mortgage insurance really plays into the APR on the FHA loan because they have an upfront mortgage insurance premium. You can see in that line, we've got it highlighted under the prepaids. So there's a $6,300 premium that's charged on the FHA loan. And again, that's really what feeds into that APR. That plus the fact that this mortgage insurance is for the life of the loan. So it's factoring it in over the entire term of the loan. And again, if you look at the difference in the mortgage insurance premium is $259 on an FHA loan versus $72 in this example on a conventional. So maybe a lower rate on an FHA, but the payment is actually higher because that mortgage insurance is considerably higher.
And this is where it gets tricky when we're dealing with buyers that really get confused by numbers and don't see that. And they're just talking to someone online who said, I got 275 for you. And they don't even understand the numbers when they're presented in front of them. That $6,000 upfront premium is not something due at closing, so it can mislead a buyer because it's financed into the loan. So they decide to pay that loan off 1 year later, they're owing an extra $6,000 over what they borrowed.
Yeah, so again, I think it's just, they're asking about APR. The things that really go into that APR is like, maybe somebody's buying down their interest rate, so they're paying points up front to do a rate buy down. That's going to factor into, they make it a lower rate, but their APR could be higher, or that spread could be higher because now they're paying extra points. So it's more costs involved. And again, that APR is really was created as a tool to compare products to see what's the best loan for them long term. Does anybody have any questions about that? I know that can be a little tricky. Okay, next screen. Okay, I think we kind of talked about this. Just little known secrets about the fees. Lender fees are truly the only variable. Again, like we discussed, most of those other fees are going to be the same regardless of the lender, as you know, from what they're driven by. You want to look and to see like if there's, you know, check for discount percentages. If the rate looks lower than the current market rate, then it's probably because there's a discount point listed in the fees.
Yeah, that's very, very common when you shop with a lot of online lenders because it's a market-driven thing. So here in the Nashville area, Middle Tennessee, it's very, very common that people want their interest rate, what we call it par. That means no discount points on it, no origination or discount point. It's just the base rate. But if you travel to other areas, Knoxville, Atlanta, for instance, those are both communities that the standard begins with a point. So if you're quoting a rate automatically, you're just assuming it comes with 1 point. A lot of online lenders will automatically quote a borrower with a 1 point rate. Again, so they're taking a $300,000 loan out, they're paying an extra $3,000 in closing costs. And you've got to really look at that. Connie and I always begin with the par rate, as will probably any lender here local in the community.
Yeah.
And then we'll offer you, if you want to pay down points, here's what you can do. Very few take it.
Yeah. Yeah. So like if our rate's at 3%, you know, sometimes I'll have a borrower that'll say, you know, well, I you know, was researching online and I saw this other company, whatever, Quicken will say 2.75. But when we actually look into that a little further, we can see that that is actually costing them discount points to get that. So there's additional fees related to getting that lower interest rate. Okay. And then, like we talked about, the accuracy and the estimates, again, with the HOA fees, things like that, that really will factor in. You just want to make sure that they're getting very accurate estimates for whatever type of property that they're purchasing.
Next, please, kind sir. Rocket Man.
Yeah, and I can't accentuate that enough as far as feeling like it's just not a simple answer. Don't take first blush of what the rate is. There's just so much more to it. So,
Well, can I say something? I can't imagine why someone would go online searching for home equity or standard mortgage. You don't know who's on the other side. You got to sit down and talk to someone. And I understand there's a wave of younger people in our industry, but I think they need to connect.
Mm-hmm. It's funny, Maria. Actually, most of the first-time home buyers, they want to come in and meet with me. And I meet with so many first-time home buyers. I mean, with any buyer, of course, but first-time home buyers especially, I think they really want to, you know, see what it all means. I'll have, you know, have them come in. We'll print out estimates. I give them several different options, and we'll go through, you know, thoroughly with them what the fees are. You know, so that I want them to understand, and they really do want to understand. So it's interesting to me how many actually do still want to meet.
I will say that's true, but I think that most of the ones I still meet have done their online homework already too.
Mhm.
They have applied at somewhere, and it's so easy for them, Maria. I mean, they're sitting on their computer and Facebook pops up and there's an ad for this. They go look at a house and there's 14 ads that pop up on the internet on every realtor's page where they're being sponsored by mortgage companies. And it's quick and easy, and they got to put in so much information to just get a payment quote. And that's how it begins. And then they start get hammered. You know, I did this exercise myself a couple of months ago, and on Facebook, I went in and responded to one of those ads. And then I was looking for a real estate listing, and I did it the way a consumer would do it. I didn't, go through MLS, and it pulled up and then pulled up a lender and get your qualify. And I went through the process myself with a fake email account, mind you, but I have access to that email account. I was then inundated for the next 2 to 3 weeks with phone calls and emails every day. So they're really being hit from a lot of places.
Okay.
Interesting.
Sorry, go ahead.
What I'm saying is that it's interesting that
It is.
where is that information? Where is the privacy of your name and social security numbers? They don't understand what I don't think they realize where all this information goes to.
Mhm. Yeah.
Connie and I also, when we talk to somebody, we get their credit report. And one of the things I always do, I'm sure you do, I look at the inquiries on it so I can tell if somebody's been shopping and who they've been shopping with.
Yeah, sometimes they think they're being stealthy, and I try to tell them the best thing to do is just be transparent with your lender. Tell them you're shopping, who you're shopping with, and why, and they'll be able to better advise you. And then depending on how that mortgage lender originator handles that, probably says a lot about their character and their process and integrity, to just talk openly and real about it rather than them feeling like they're trying to hustle and work the system. They're typically not winning. Yeah.
All right, top 10 tips for getting to the closing table on time. Connie, number 1.
Getting pre-approved. This is really the biggest thing. Getting a pre-approval and actually supplying the documents to the lender is huge. Just cannot stress that enough. So many things can change from an application. Somebody's filling out an application, putting in their, what they say that they earn, and we're able to pull the credit. That gives us that's that first step of a pre-qualification. But quite honestly, until we really can document their income, document the assets that they have, see, especially if they're self-employed and we're looking at tax returns, someone may go online and fill out an application and say that they make, $150,000 a year. If they're self-employed, they might write off, 100,000 of it. Now you're looking at a net income of 50,000. That's what we have to qualify them on. So it's so important to get those documents up front. And, that I think that's the biggest step, that if we can stress nothing else, that's, really what we need more than anything.
On the reverse, and I know that y'all are fighting. All my realtors are like, I need to go higher. I need to go higher. 250 is not enough. Can you get me to 3? One of the biggest things I see, applicants apply. Again, they don't know what they're doing. So one of the questions is, how much do you make per month? What is your salary? 7 out of 10 times, I'd say, I've not formally done this, but I bet I'm really close. They put their net, what their paycheck, what gets deposited into their account. You've just shorted yourself, $1,000 or $1,500 a month in qualifying income. In the world of mortgage, we use your gross income. So if you're paid a $52,000 a year salary, we do 52 divided by 12. But they're losing to FICA and Social Security and to their 401k deduction and all of that. And they're putting that dollar amount in. I see that happen over and over and over, which is why it's so important to get actually pre-approved and let us see your documents.
Yeah, so we can do a pre-qualification based on someone's application, but again, we really encourage them to send us their documents as quickly as possible. And anytime that you're working with someone, just if you can stress that to them as well. And besides, we're able to provide a stronger approval letter just by even adding that information to the approval letter itself, saying that we've already reviewed their income, we've reviewed their assets, and it's sufficient for their purchase and for their closing.
Another big part of that too that people miss, it's not always just about the income. A big thing that comes up is deposits and where their cash is. How long they've had their cash, where their cash came from, was their deposits to account, things that will cause Connie and I and the borrower to have to go through a few more hurdles in the process. Or delay close or delay when you can contract until money is seasoned. Like that comes up a lot. And if we don't get your bank statement till after you've gotten a contract, there's not a lot of wiggle room there for us anymore.
So and then comparing loan options. I mean, again, we want to go through, and this is, again, helps them getting to that closing table on time, being able to review those options with them, whether they're going to need to do an FHA loan, do they need to have any closing costs paid for them, or are there other options? I know in this market, you really can't ask a seller to pay closing costs, or it doesn't seem to be much of the norm anymore. But, say somebody has a very, limited amount to put down, we may be able, just like someone can buy down an interest rate, they can actually get a higher interest rate, and finance their closing costs into the loan. So, when you are hearing buyers say that they want to finance their closing costs, that's how they're doing it, is by taking that interest rate up higher. And then we're actually doing a lender credit. So they're financing their closing costs over the life of the loan. We may need to have those conversations with them, especially now where you're not really wanting to ask a seller for, to help participate in those closing costs. If you're trying to make a stronger offer. So, we're going to sit down and compare all of those options with them so there's no surprises down the line. And we'll discuss strategies for financing. Are they, if they're paying over list price, which, is happening all the time now, where if you're paying over list price, setting that expectation, if the appraised value comes in short. So if a property is being listed at 400,000, it's being listed at the top of the market. Someone's listing, if they're looking at doing whatever, $20,000, $25,000 over, then I think having those conversations up front of, what do you expect to happen if the appraisal comes in, at the $400,000 mark? Where is that money going to come from? Because you've just, they've accepted your offer at 25,000 over. So, let's put together a strategy as to what's going to happen if that appraisal comes in short. I think those are big conversations that we have to have anytime that we know that they're offering over list price, which I think is, like I say, it's like all the time now, isn't it?
All right. Review down payment assistance options. This is something Connie and I do standard, and any good loan officer should be looking at all the options for a borrower. If they're a first-time home buyer, we should look into anything that may help them. One thing to really keep in mind that a lot of people don't know, almost every first-time homebuyer program is also tied to income. They're income-based programs, and so there's a limit on how much. Some programs are for the only person on the loan, some are for the whole household. Mm-hmm. So if they've got a wife that works even though she's not on the loan, or a grandmother that lives with them and gets Social Security, that can play into it. So a lot of times when we're saying there's no program eligible for them, it doesn't mean they're not eligible because they're a first-time home buyer, but they probably make too much money.
And discussing the timelines and expectations, this is big because it's like, first of all, we have to have all of their documents and their disclosures signed before we can order their appraisal. So again, we're trying to really emphasize how important it is for us to get those documents and for them to sign those disclosures right away as soon as they're under contract, so that we can get that appraisal ordered. They're just taking longer. Appraisals are, they're so booked up right now. Trying to find somebody to go to an area that's like further away, it takes longer to get that appraisal ordered. There's so many appraisers that just don't want to, go to Ashland City or anywhere else. So, and then we discuss with them, like when we get the closing disclosure, that they have to sign that. It's got to be signed with at least, prior to the 3 days of closing. or it could push their closing back. We actually send our closing disclosure, preliminary closing disclosure out as soon as we have an approval on the loan. So early in the process, as soon as we have an underwriting approval, we're going to send that closing disclosure out to the borrower, and we'll send you guys a copy as well. So you can review it, but we don't wait until the file is clear to close to send that preliminary CD out. We want to make sure that that's out as quickly as possible so that we're not pushing those timelines for closing.
Some of those big box banks we were talking earlier and online lenders do wait until they have a final clear to close, which is sometimes why you run into closing date issues.
Mm-hmm.
And that is just part of their workflow, their process, and their checklist with very little exception.
Yeah.
So.
Yeah, and then we're going to discuss each stage and how long it'll take, as far as processing, underwriting. And the type of loan too, if they're doing a loan that's a USDA, those loans typically are going to take 45 days because we have to do the underwrite and then send it to USDA and they have to do their underwriting. And sometimes they're, as quick as 3 or 4 days, but they could be as long as a 2 to 3 week period. So you always have to factor that in on that type of a loan. And we try to set those expectations up front so everybody's prepared.
Next, please. It's always good if your borrower, if you know any of these things, anything kind of outside the general norm. Are they planning to withdraw from a 401k? Are they wanting to put their loan into a trust? Are they getting trust income? Are they not going to be in town for closing and they're just expecting to do a POA? That happens sometimes and they think that it's no big deal. They knew it all along that they were going to be in China that week and that the wife was going to sign and never bothered to tell us until the 2 days before closing. So those things really, really matter in our world, and letting us know as soon as you know can help us make sure that we navigate the trees and still make your closing on time with everything prepared and ready to go.
Mm-hmm. Yeah. And then, we try to let everybody know up front, to call us or if just to be prepared if, any of these items occur, utilizing credit outside of the norm, opening new credit, obviously we try to discourage that. And I think, again, we try to do a really good job of preparing people, please do not do these things. If you do need to, just call us and have that conversation with us. Sometimes it's fine for someone to go ahead and buy their furniture up front, but we make sure on, with that situation that it's not going to impact their approval. Are they buying cash if they're using like their debit card, or if they're going to use their credit card and just pay it off immediately, so that it's not incurring any new debt, then, as long as, again, they're having that conversation with us up front, and we try to let them know, early on in the process that if any of these things occur, please give us a call first. Don't buy a car, don't change your job, just obviously some basic information. And then reviewing and signing the documents in order to stay on target. They all have to just make sure that they are, doing that, getting those documents to us quickly, as just responding to us, to the loan officer and our team for asking for anything, then, just that they get it to us right away. Like the insurance, I think, don't they have to have their insurance within 14 days per the contract? So we try to, again, encourage all of that so that they're not waiting till the last minute to get those things in place. That all has to be in place.
Yeah, one of the things that happens is you get us a contract, and then hopefully within 24 hours, we put that into the system and done all the I's and T's. We then officially disclose. So we send them a large package of disclosures, and they only have 3 business days to actually acknowledge and sign those, or we get to begin the process all over again. So it's really imperative that they jump online and that they click, and sign, call us, meet with us in person. But we have to have those signatures before we can proceed to the next step. So that's why that timeliness is so important.
And lastly, I think just alerting everybody to any changes that take place. So if there's a change in the purchase price, if you guys have negotiated the seller to pay, some kind of a credit in lieu of repairs, You know, we need to know those things right away so we can make those changes in the loan itself and just discuss with you, you know, what's acceptable. You know, we don't want to see on an amendment that the seller is paying $5,000 in lieu of repairs. That's like a big red flag. So we just like want to walk through the verbiage on how that needs to read, what an underwriter is going to want to see on that. So just anything that changes like that, just reach out to the lender and let them know. If somebody needs to sign with POA, if they're not going to be present, you know, it actually is, they're very restrictive on who can sign the POA for the buyer. You know, anyone who's an invested, has a vested interest in the transaction cannot. So, you know, you as an agent cannot sign on their behalf. The title company cannot sign on their behalf. They could for a seller, they don't care about the seller, but on a buyer, you know, Fannie Mae, Freddie Mac are very particular about who can actually sign for a POA for a buyer.
I know we're running tight on time, Ted. What's the next slide show us?
I don't know what that is.
Next slide is questions.
Questions. Any
perfect.
questions?
So it's perfect timing.
Mhm.
Does anybody have any questions? I may have a couple to share. Yes, Lisa, go ahead.
When we were taking, I think it might have been the actual real estate courses, they were telling us something where if the county is considered a farming county, there's 0 down on all properties available.
That's a USDA loan, and it is 0 down. That's correct. So anytime that you have a customer that's looking at rural property, it's a wonderful program. It is income restrictive, so they can't make over a certain amount. And a lot of that is driven by how many people are in the family. So, you know, we just have to kind of plug it into the system. The other thing, though, that's the main thing on those programs is the property itself. We have to actually put the address into the USDA system and see if it's eligible, because the property has to be eligible. Obviously, you know, they're rural properties.
If you'll
Anyone,
say that
go
again.
ahead. You can go ahead.
I was gonna say, if you'll email us, I'll send you over a link that'll kind of show you just a general map of the eligible areas and the income. It's a great program.
Would you mind putting your email address in the chat if you haven't already?
Happily. Anyone else? Can you type in our emails? Ted, do you have any questions?
I'm here. I was wondering if you could touch a little bit on like the difference in, some people ask like, oh, I'm going to get a loan with my bank or versus a bank versus a mortgage broker, or, I mean, I'm sure there's positive and negatives to every brokerage, every lending solution. Is there just some things we should know about those differences, or is there just, it's case by case based on what relationship the LO or the loan officer has with underwriting? Do you see that as the biggest difference in some of the inner workings of lender choice?
I would say that between banks, lenders, and brokers, those are the 3 categories. And a lot of times we just kind of all get lumped into one, because 60 or 70% of the business we can all do very, very vanilla like the same. A bank offers in-house products. So a bank does Fannie Mae, Freddie Mac, VA, USDA, FHA. But then typically they've got construction loans, they've got equity loans, they've got portfolio loans. That's how we do our non-warrantable condo loans that so many people here at Village have had to use with all the Airbnb products, things of that nature. We still lend with our own money. We underwrite with our own people. We have our own staff. A lot of times we're direct to Fannie, direct to Freddie, meaning we don't even go through an investor on the backside. A mortgage lend, okay, then let's go to the far end. The far side's a broker. A broker is an independent person who, you know, hangs his own, he has to have a bond, he sets his own shop up, and he sets up relationships with wholesalers. So lots of banks, like my bank, First National Bank, can be a wholesaler, some brokers in town. The brokers basically package the whole loan up, they process it, they originate it, they follow all the rules, and then they have to send it to the bank to be underwritten by the bank. They're subject to extra overlays. They don't always get all the perks. they have more control over their rate because basically they're just putting a chunk more into their own pocket as the originator owner of that broker shop.
I see.
They're basically independents. Now the hybrid in the middle is a lender. A lender is like a really big company and probably started out as a broker a lot of times in the beginning and grew. A lender, a broker doesn't close in their own name, which is really important as well. Closing documents are going to come in the name and be funded the check by the company they brokered it to. They're a middleman. A lender has all of their own money. So they're still, we originate, lenders have their own staff. A lot of banks actually have mortgage lenders. A lot of banks, their mortgage division is actually a third party legal company under a different umbrella, operating as a mortgage lender. Anything to add to that?
I think when you get into sometimes the larger banks or online companies, you're going to lose a little bit in as far as like just them having, appraisers that they use locally.
Yeah.
So there's just definitely a disadvantage with I think online or some of the larger banks.
A lot of them have moved very automated
Yeah.
over the last couple of years, extremely automated in phone app. And with that comes positives and negatives.
Yeah.
They can pull your bank statements. You give them permission and you're basically putting in your password for your online access to your checking and savings and retirement accounts. And they're pulling everything they need. Now to the big bank, they've cut out a lot of ability for fraud. They've cut out a lot of time. They've cut out a lot of labor. But with that, they've removed all flexibility that sometimes it takes a good LO to make a loan work.
Yeah, because we're going to look at those bank statements and see if there's anything that's a red flag or a concern, and we can choose what we're actually going to put in the file rather than it just being automated.
I don't have to submit all of your checking and savings accounts if you have money in this other account.
Well, and I like that for, I bank with Bank of America, which I've got plenty to say about why I don't love them, but there's certain things about their online tools, but I would never get a mortgage with them because I don't want them to have just carte blanche access to all of that information. In addition to, I hear sometimes buyers think logically, they may work with a local bank and they feel like they might get taken care of well, whereas sometimes I feel like I want to give that specialization to somebody that just does that, because otherwise I might get put with somebody that's just sort of the in-house person, right? Where it's just like they're in the cubicle metaphorically. And
Exactly.
I can't rely on the fact that I have a relationship with them and I know that, their family eats because we close deals just like mine, and versus, somebody that might be more of a salary based, they clock it at 5 type of thing. So that's one thing that I sometimes discourage people, or to evaluate more critically, of giving their loan to their bank holder or their regular bank.
That's kind of something too that not all realtors know. Connie and I are just like you. If the deal doesn't close, we do not get paid. So we're doing everything in our ability to make sure a loan gets played, and we rely on referrals. So just like you, we're all about customer service and efficiency because we want them to tell their friends, tell their family, and to come back to us again.
Mm-hmm.
Yeah. Well, I'm
Any
so
other
grateful.
questions, Ted?
Any other questions? There's so much we could talk hours and hours on mortgage loans, but Connie and Roger are so fantastic to be with our team and have so much experience. Feel like we've been together for so many years, and know that you can call and ask them anything, and real openly, and just encourage your clients and you as a realtor is that they're your best adversary or ally in the deal, to help get these closed. So the more information that you can share and the more honest, I feel like the better it can go. And I'm thankful for all of you that joined us to educate yourself to better give to your clients, to be the source of the source and give them the tools to make best choices. So if there aren't any other questions, please raise your hand or put it in the chat, or we'll close.
Right.
What is the name of the company? I see you've got FNBFG as your email. What is the actual company name?
We're
First National Bank.
It stands for, it's the acronym for First National Bank Financial Group is what that stands for. You know, these companies create email address domains way back when, and they don't always make sense when they first did it.
There's a question here about bridge loans. Do we want to answer that real quick? Let's see.
Oh, yeah.
Hang on just a second. Let's see.
It says, can you talk about bridge loans for sellers who want to buy but can't win with a home sale contingency?
Mhm.
Can you?
Yeah. So yeah, we've actually been using a lot of the bridge loans. Our company, the First National Bank, does the bridge loans. We can go up to 90% of the value of their current home. So that gives them that money for the down payment without having to sell their house. Now they do have to qualify for both the new home mortgage and the bridge loan along with their current mortgage payments. So as long as they can carry all of that debt, they can qualify, get be able to access the down payment from that bridge loan. Now, another thing that we've been able to do, I just used this on a customer, is they weren't actually able to qualify with all of those payments. So what we did was we used the bridge loan to pay off their first mortgage. Then I only had to use the interest only payment for the bridge loan, reduce that payment significantly, and then they were able to qualify for both. So that's been a wonderful tool.
Nice. And then what about, Annie also asked about, can you talk generally about construction loans?
Yeah, so we do construction loans. They'll go up to, so if somebody's wanting to purchase a home, well, actually, I guess construction, if they're buying land and building the house, we'll go up to 85% of the overall purchase price. So they're acquiring the land. If they already own the land, we can use that as part of that 15% requirement. You know, so they may not have to come out of pocket for the construction itself because we can use the equity in the lot as well. Otherwise, yeah, we're looking at an 85% loan to value. They will pay as the construction money is funded. So, you know, as that is increasing over that period of time while the home is being built, that's what they're build on. And it's an interest only payment. They typically have up to a year. And then we'll do a takeout loan at the end of that, refinance them into a just a straight 30-year fixed at that point.
Awesome. Thank you. And then 203Ks. Do you do that? And is that the best solution for people buying renos or fixer-uppers?
You know, we don't do the 203K with First National Bank. I mean, I've worked at companies in the past that we have had that product. It is a good product. I've found honestly that our construction loan that we're able to do seems to be able to meet most people's you know, requirements, and seems like it's a very good alternative.
Yeah, because we can use the construction loan as a renovation product as well.
Mhm.
I've got one going right now, subject to plan specs, the whole kind of 9 yards. He wants it to come in at 80% when it's done. The 203Ks are an FHA product. Some people do them and do them really well. There's one guy in town, we probably all know him. He's excellent at it,
Mhm.
but it is a very regimented product. There's no flexibility in it. And the problem, a lot of times when people begin, you know, I had 2 houses last year in East Nashville. Both of them were, you know, late 1800s built homes, and added $100,000 to their remodeling project once they really got the floors and the foundations open and broken into. On a 203K type product, that would have been a disaster. But with the bank, we had the flexibility to adjust and go from there, and we did. And you end up with the same result.
And again, sometimes it may be better for that customer to do the 203K because there is a very small down payment required. They still only have to do the 3.5%. And if that's the case, we would, you know, certainly recommend that they use, you know, someone that we know that does those. But we find that the alternative is nice to have the construction loan, the renovation loan that we can do, because then they're also paying as that loan is increasing, rather than on the 203K, they do the loan all up front, you know, figure it all out. And they're actually paying on the full loan, even, you know, from the beginning, even when they haven't even dispersed any funds yet. So that's, I guess, the disadvantage.
But it's certainly a good product for anyone who needs that situation. And I've referred many away.
Yeah.
Even when I had them, actually, because that's a product that you really, that's where Ted talks about us being open and transparent. Even when I've been able to do 203Ks, it's usually not something that I want to tackle. I don't do them enough to be an expert at it. And I would just refer that to a partner.
Yeah.
It comes back one way or the other later.
Well, you know, it's similar to us. We can't do all things great. I mean, it's just true. And the better we focus on what we do well and find partners for the other or collaborate with others, the better we are all in the long run. And I think that the referrals will flow. So I value and appreciate that about you both. And thank you for the questions. Annie, Lisa, did you have any other questions or anyone else on here? Yeah, go ahead, Lisa.
Yeah, I've been talking to some of my contractor friends, and you know, with the price of lumber going up 188% and wire and concrete going up 40%, he's smiling. I already see him. How do we help our clients protect themselves if they get a construction loan or a remodeling loan, then all of a sudden it shoots up 15%, the cost of, you know, the whole, you know, cost of having it finished?
Again, to transparency and honesty, I've had that conversation with many of my colleagues, and we're all in the same boat. We all really don't know the answer either. We're concerned. We have people under contracts for second homes and investment properties, people under construction contracts to close at the end of the year. And given the tightening of the market, given where rates are going, we don't know. I don't know, be more, you got a better answer, Connie?
No, well, I mean, they do factor in like a 10% overrun, you know, cost overrun into the construction loans or
I've been hearing 10 and 15% even. You're right.
Yeah, so they do have that, you know, built in for that any type of overage, but you know, it may or may not cover it all. Hopefully that at least most of it.
But you got to imagine that the lender too, and the bank at the end, and the builder, nobody wants, if things go a little bit more awry and things get out of shape, nobody wins if it doesn't close.
Mm-hmm.
The seller doesn't, the builder doesn't, the bank doesn't want a product stuck out here either. And like, so there would be somehow that we'd all come together, the powers that be, the loan officer, we'd be in tune, and we would find a solution to make it work. I've never been where I couldn't find a solution. It may take compromise on a lot of people's parts.
I was curious about that.
It's a good question.
It's a scary proposition and truth out there right now, right? And we're all trying to navigate it together. Great question, Lisa. Any others? Awesome. Well,
Happy April
appreciate
1 to
you.
all of you.
We appreciate you so much. And thanks to everybody that's on here. If you want to reach out to Connie or Roger, their information is easily accessible in all places. You can just Google them and find them very, very easily. And they're also in the Village directory, which is in your agent toolkit. So
All right, well, thanks for having us.
thank you so much. I appreciate you.
Have a good one.
Thanks.
Good luck out there. Everybody be good to yourselves. It's tough.
Thank you, Ted.
Take care.